Welcome to the Millionaire University podcast. I'm your host, Brien Gearin, with you today. And on this edition of the MU Pod, I'm joined by Yoav Gilad. He's the owner of Greenblock Incorporated, where he helps accelerate real estate investors' growth by lending and advising. Yoav, welcome to the show.
Thank you very much, Brian. It's a pleasure to be with you.
Yeah, this is going to be fun because we're going to be exploring a little bit about what you do in terms of at Greenblock as a lender. So you have a really cool story in real estate investing, and I want to make sure we do some justice there to kick it off here. So I'd love to get your origin story about how you got to where you are today, and then we're going to talk all about real estate lending. And it kind of sounds like you have a pretty cool story about how you got there. So tell us all how it started out.
Awesome. Thank you again. So I remember when I was a teenager at some point reading an article in Forbes. I think I was like in a dentist's office or something, and it was like the top 500 wealthiest Americans, and the list was basically, I realized, about 2/3 people who were in real estate. For whatever reason, that it hit a chord. It struck a note with me, and when I got to college, this was right before the Great Recession. You could get no doc loans, and it was easy, and the money was there, and it was relatively cheap. It was probably actually pretty similar to where rates are today, but you could get no doc loans. And so, remembering that article that I had read, I thought, well, I could buy a condo and get 2 bedrooms and rent one of them out to a classmate, to another kid that's with me in college. And so I did. And it was just as easy as it sounds. It's like I found a place, had the down payment from saving and working or whatever, but got a no doc loan because I was in college full time. I wasn't working, I was just studying. 2 years later, I sold the condo and I bought a house, 3 bedrooms this time. Same way, no doc loans, and just rented out 2 bedrooms to other students, and it was great. Went to work. I didn't really continue the process. I didn't keep growing from there. It was kind of a passive side thing, but I knew that I wanted to own my own place. Eventually, I met my wife, and she's my partner. But she was kind of sick of her job. She worked for the NFL and loved sports, but it was, as you might imagine, kind of a boys' club, and she'd been there for a while and was kind of getting passed over. She was also interested in real estate, and did like one of those flipping guru classes. And all of a sudden, where I'm working my job, I think I was an automotive journalist at the time. She is going into real estate, and we had our own house, but I think I'd sold the properties earlier. But we started flipping, and I say we because about a year after she started, I actually got fired. And while it was very embarrassing and terrible at the time, it was actually a blessing in disguise. But we started flipping together. And then, coincidentally, one day someone asked us for a loan, which was something that we had never imagined we would do. We were just flippers. But we decided to take a chance, wrote a loan. It wound up going bad, but it wound up also turning into this great new career, great new avenue in real estate that has just been wonderful ever since, basically. And that's kind of what got us to where we are today.
Okay, so now you're doing lending, and you're no longer even flipping homes. Is that accurate?
Yeah, the last flip we did was about 3 years ago, I think. Might be a little longer, but yeah, I mean, unless we get something that's just smoking that someone brings us, like, we're not interested. Yeah, we're lenders now.
Okay, so let's dig into this now that you're lending. So it sounds like the opportunity came kind of by happenstance. It sounds you said it didn't go well, but I'm sure you learned a lot.
Yeah.
What put you in the position to be a lender? And when you first were approached by that, was it just kind of like, I guess, sure, why not? Let's try it. And like, what type of process did that look like?
Well, so it was. It's funny. The person who approached us was not asking for a lot of money. They wanted to do Airbnb arbitrage, and so basically the idea was they would lease out a condo, and they were upfront with the landlord about what they were going to do. But they leased a condo, and so we provided a small loan so that they could put the first month's rent down, the security deposit, and buy some furniture so they could then post it on Airbnb and make money, in between basically. But they offered us like 30% a year, which was a great return. Unfortunately, that was illegal in the state of Michigan. It actually violates usury law. But having spoken to an attorney who was like, as long as you keep it under 25%, you can lend. And initially, our reaction had been, we're not Bank of America. What are you talking about? Can we even lend money? But so we wrote our first loan for $10,000 to do this Airbnb arbitrage deal. Eventually, the borrower did default. We never got paid back on it. We made interest at 25% for about a year and a quarter. But got a great education, and people in this area, we're in Southeast Michigan near Detroit, heard about, the, our loan. And so someone else approached us, hey, will you lend me money on this? And that was more straightforward. It was a single family, it was a flip. There wasn't anything kind of weird about it. The real issue with the first loan wasn't so much that the borrower defaulted, it's that we didn't know enough at the time to secure the loan, to get collateral. And so when the borrower walked off, we were left with nothing. So on the next deal, we knew enough to use the property as collateral. But yeah,
Okay.
from there we were off and running.
Okay. So is this an industry where like like you're a husband and wife team and your lenders, is there a lot of competition in this industry, or are you guys kind of always going up against the big dogs like the banks and the mortgage lenders like Rocket Mortgage and stuff? How does that work?
Yeah, so we don't compete with companies like Rocket Mortgage, because we don't finance anything owner occupied. We strictly finance investment properties. So, like fix and flips. You may have heard of wholesaling, where someone gets the right to sell a property on someone's behalf. And I'm not talking about real estate agents, I'm talking about wholesalers. And so we'll do what's called an A to B, B to C close. So the wholesaler closes with the original seller and then sells it to the end buyer. We can provide transactional funding for stuff like that. But most of what we do, again, is fix and flip, ground up construction, and then 30-year fixed rate rental loans, which are for the purchase of a rental property, not so that you can pay your rent for 30 years.
Okay. So like a client type of yours would be someone who is a real estate investor themselves, and
Right.
let's say there's a 10 unit apartment complex that they want to purchase. Average price, let's call it $800,000, and they come to you because they can. Like, what's the benefit for them coming to you as a lender versus any other lender?
So the main benefit is that number one, they don't tie up their own capital, but as opposed to another lender, is basically speed. We can do these deals much more quickly than a conventional bank would. If you go to Bank of America or Chase or any of the big banks, it's going to take probably months to get your deal closed. Whereas with us, it's typically under 24 days. If we can get an appraisal more quickly, then it's under 3 weeks easily.
Okay. So what led you to be able to become a lender? Like, was it just the fact that you guys have been flipping for a long time and you have, a nest egg to pull from, or like how does it actually work as a lender?
Yeah, so there are a few things that I would say you need to consider if you're interested in going into the space. Number one, we had the sort of background knowledge just because we had been flipping for a while at that point, and we knew how to underwrite deals. Like we can tell if your deal is a good one or not, and so having that knowledge is really important. But yes, having the cash yourself, especially when you're starting out, is also very important. And basically, through doing many fix and flips, we had established a good sized nest egg so that we could fund other investors.
Okay, so the average type of loan then, like what does that number look like for you?
Because we're in Southeast Michigan, although we can lend in 45 states, our average deal size is about $180,000. And that includes both purchase and rehab. If we were in a market like Atlanta, it would probably be double that. And then like Los Angeles, triple to quadruple. But yeah, our average deal size is not huge just because Southeast Michigan is not expensive.
Okay. And then do you mostly stick to local Southeast Michigan area or do you do deals elsewhere?
No, we do. We've lent, I think, in like 12 or 13 states. So yeah, we're funding deals anywhere we can. We do actually like funding deals in the South, in particular, because the deals are bigger, as I mentioned, compared to here, but also there are a lot of them down there. And the people who borrow with us down south in Tennessee, the Carolinas, and Georgia, they tend to have a lot of velocity. Like they're turning deals over one after the other, so it's easy just to
Hmm.
keep the money going.
Wow. Okay. So when you first started getting into lending, you had that first one, got your experience. How did you get the next two, three, four, 10, 20 deals? Did you have to market yourself? Was it all network? What did it look like?
Yeah, it was pretty much all word of mouth network. We're lucky here in Southeast Michigan that we have a lot of real estate investor groups, and so you can go to a different meeting at least once every week, sometimes two or three a week. So I went out and basically hustled, talked to a lot of people, started spreading the word like we're transitioning from flipping to lending. If you've got a deal and you want someone else's money, give me a call, and that's basically how it all started.
Okay. And knowing that as a lender, is your goal to keep the deals smaller? Or is it to increasingly be lending more dollars?
Our goal is to lend as much as possible. I mean, we would love to be the rocket mortgage of private money. Unfortunately, we're a little bit behind the big guys in our segment, but our goal is to lend as much as we can, and we'd love to do bigger deals.
Okay. So for somebody who might be in a position to consider lending, um, what would be your advice? Let's say they're following a similar path. They're invested in or they're involved in real estate investing. Maybe they're flipping homes. Is there a certain level you have to attain to be able to even consider lending, or is lending something you can get into, kind of from ground zero, if you will?
I think the main things are sort of knowing what you're getting into. I think having some kind of background education is important. You can always pay for that. We we get appraisals. We require appraisals sort of to double check our work. But if you don't know how much things cost, getting appraisals, getting inspections, knowing what kind of work is required is crucial, into getting into this industry. You can just trust that the borrower is being straight up and knows what they're doing, but that will lead you to just unimaginable pain.
Hmm.
Like we've gotten it wrong a couple of times, and sometimes it's been all right because the borrower is honest and is straightforward. But sometimes they don't know what they're doing, and if you don't either, then it's going to be bad. Um, we since we had our first deal go bad, we've written hundreds of loans, and we've had three others go bad in that time. And they were all, I think, in 2018, early on, relatively. Two of them we broke even on, and on one we lost about 50% of the amount we had invested. So if you get lucky, if something goes wrong, you break even. But there's definitely the potential for loss. So I would say learn as much as you can. I would also learn what you can and can't do. I would definitely have a lawyer on retainer, just because if you don't know what the rate of usury is in your state, and it is state to state, again, like you end up in court and the judge just doesn't like what you're saying or whatever, how you're doing business, you're going to owe a lot of money. So I would say knowing about the laws in your state is very important. And then finally, having some cash, and just ensuring that you're not putting everything into one deal, because if you get wiped out, you're done investing, at least for the foreseeable future. So those are probably the three most important things.
Okay. So what are the few of the lessons that came from the clients or the deals that went south?
I'd say most of the lessons were related to the borrower. If you ever, and it sounds all well and good and easy, but we've made a lot of mistakes. But for instance, if you ever hear anyone tell you, no matter what, I will pay you, just run the other way. Like those people, number one, will not pay you no matter what. And number two, like it's you're just going to have a lot of bad days after lending them money. Yeah, like
Do you have a lot of recourse as the lender if somebody defaults?
you do, to the extent that it's not that hard in Michigan, for instance, to take the property. It takes a lot of time, usually from like start to finish. The foreclosure process is about 9 to 10 months in Michigan. I know in other states like New York, it can be up to 2 years. Um, but yeah, I mean, in terms of getting back any monies owed on top of that, it's not so easy. So on our first deal, where it was an unsecured loan, we sued the borrower. We got a judgment, and then literally the following day, the borrower declared bankruptcy. And so it's like, well, great. Now, what good is a judgment? You're just not getting your money back. Yeah, I mean, it's hard to collect money. It's not so hard to get the asset itself back.
Okay. And I guess some of the red flags that you could pick out as the lender, is it kind of your basic like I guess is it really is it difficult to pick out those red flags, or is it just plain as day and sometimes you just want to get going and you take the deal anyway?
No, it's in some cases it's pretty easy. Like there are people who come to us that are probably very good and very nice people, but they have a very low credit score. In those cases, we won't write the loan. It's just too much risk. We change the interest rates a little tiny bit based on credit score, but to make up for the added risk of lending to somebody with like a 550 versus 750, I'd have to double the interest rate, and like it's just not worth it. But then there are other times where like you just can't see that something is wrong. There's no tell, and those are the scary ones. And so you do the best you can to really underwrite a deal, but sometimes you just can't tell. And then there are other times where people have the best intentions in the world, and yet the loan goes for double the amount of time that it should. um, and so it's difficult, but we try to work through it with the borrower.
If you're dealing a lot with rental borrowers, or folks that are borrowing in order to purchase a rental property, that seems to me as an outsider that that would be a more risk averse person to lend to, because they're going to have this property and they should be able to rent it out, right? Which there should always be money coming in. Is that the case, or am I off base with that?
No, you're totally right. Usually we can write 30-year fixed rate mortgages on rental properties, and I don't know how many of those we've written. It's a big number. I mean, 3-digit number, and we've only had one of those ever go bad. And I think more than anything, the borrower just wasn't interested in listing the property or something along those lines. There's no real reason why you should go bad on like a. I don't remember what the rate was. I think it was like high fives at the time. But like it should have cash flowed.
Okay.
So yeah, those are
So
less risky typically.
gotcha. Okay. I thought that made sense.
Yeah.
What about so if you're looking to become a lender, what are the steps you need to take in order to be able to do that? Is there like licensure through your state or through your county? Is
Yeah.
like what type of ducks do you need to have in a row to become a lender?
So it definitely depends on your state. In Michigan, I don't have to be licensed. In other states, we do. I would check with your state.
Okay, so all at the state level. And then is there any form of education outside of your own school of hard knocks that you need to get, or is there like courses that need to be passed, or how does that
So
work?
again, it depends on the state. Most states that require licensing do have some kind of educational requirement, or some do. Beyond that, there's not a ton out there besides YouTube University. There's something also called the American Association of Private Lenders that offers education. Um, but yeah, I mean, it depends on the state what the requirements with regard to education are. But here in Michigan, it's like if you're willing to lend your own money, good luck to you.
Hmm.
Yeah,
Okay. Is there a lot of competition in the, I guess, smaller size lenders? I don't, not to say you're small, but
yeah, yeah.
compared to the medium, large, big size ones, is there a lot of competition in what you do, or is it pretty easy to continually bring in new business?
Uh, it's I wouldn't say it's easy. I also wouldn't say it's hard. Uh, there is competition at every level, where whether you're like the number one or no one's ever heard of you, there is always competition. Um, yeah, I mean, you people are always looking for money, whether it's from a bank or their uncle or their friend or whatever. I think the level of competition depends more on how much you're looking to borrow. But having said that, like, not everyone has $100 million, including ourselves, to lend for 10 multifamilies or something like that. So the competition and how sophisticated it is depends really on the size of your loans and the market that you're competing in, I think. But yeah, I
Okay.
mean, we have competitors, and we're on good terms with all of our competition, which is helpful also because you kind of trade best practices and learn from each other. I wish there wasn't any,
Mhm.
obviously, but at the same time, like, it's beneficial. It makes you better, it makes them better, and it helps the
Yeah,
consumer, I think.
it's the art of competition.
Yep.
Is there a ceiling on how much you can lend at any given time, or
Not
how much you
really.
want
I
to lend?
think, yeah, it's kind of just a function. If you're speaking about you generally, it's just a function of what you want to do, how much risk you want to take. Um, but yeah, no, basically the more cash you have, the more you can lend.
Okay. And then you mentioned how you really enjoy doing deals down south. It sounded like kind of for the velocity of being able to do them. Is there something inherently different about working in those states, or is it more of a cultural thing where things move quicker, or is it because there's a lot of development down there? What does that look
Yeah,
like?
there's the South is growing. I don't think that's any secret. The South is growing pretty quickly right now. Number one. Number two, the real estate is worth more than it is in Michigan. My guess is probably in most of Ohio and Indiana, basically in our surroundings. I mean, Atlanta, Nashville, Memphis are all exploding. The Carolinas as well, as I mentioned. So yeah, there's just a lot of deal volume down there. I don't think the kind of Eastern Midwest is growing as quickly. I know Michigan has been flat for years. So there's just a lot of opportunity, and there's a lot of construction and also a lot of flipping.
How have you been able to grow your network down south, or somewhere you're not living?
It's been tough. A lot of it is digital, social media, stuff like that. But I love driving, and so I've taken a few road trips just from Michigan down south, to attend real estate investor events. The way that I started here, I will eagerly admit that it is not the most efficient use of my time. But like I said, I
Mhm.
love driving, and every time I go down south, I hit the tail of the dragon. If you know, you know. Yeah, so for me, it's fun, and I also enjoy meeting people and just learning more. So
Yeah. Is there a specific city that you target to work in, or is it kind of wherever the opportunities lie?
it's wherever the opportunities lie. I do enjoy Atlanta, and I like the people down there. Not to say that I don't anywhere else, but I find it kind of very conducive, and the atmosphere around Atlanta very conducive, both to real estate development and rehabilitation and lending.
Does when you're writing a deal in a different state, does that make it more challenging, or is this part of it being a little easier? Is perhaps in Georgia the ability to do that is a little less cumbersome, maybe?
No, I think every state has its nuances, that you have to be aware of. For instance, I don't know, in Georgia, you don't use title agencies, you use attorneys. So
Hmm.
that's a little different from Michigan. So there are things that you have to be aware of, but I wouldn't say like, any state is really easy or any state is really difficult. It's just different.
Okay. So what's the earning potential for a lending business such as yours?
Oh man, I think it's only limited by how many loans you can write and how much access you have to capital. Those are basically the limiting factors. I guess that's true for all businesses. How many customers and how much cash do you have to continue delivering? But it's basically unlimited. I think the biggest companies in the space are lending billions of dollars a year. I wish we were in that space, but we're not. But yeah, I mean that's the goal. Like I said, to be the rocket mortgage of private lending. So
Okay. And is the your ability to lend, is that all based on the money that you bring in from the loans that are currently out there? Like, does that just keep adding to the pot that you can write loans from, or do you also have to acquire capital on the back end?
both. Well, so yeah, I mean, all the money we earn, we put back into the business, but we're also always, talking to investors and other lenders um, to get more capital so that we can kind of meet the needs of all of our clients.
Okay, so it's you kind of have to build a little web of capital, being able to get more capital, essentially, right? Because the
Right.
more you can do that, the larger your pot gets, and the more ability you have to write more deals.
Totally.
Okay, okay, that makes too much sense. So, if you were talking to somebody who really wants to get into lending, what is the very first step they got to do?
I think the first step is just learn as much as you can about what you're trying to help people with. If that's fixing and flipping, learn how to fix and flip. Learn what separates a good deal from a bad one. Basically, learn to underwrite real estate investing. And once you can do that, there are other things you need to worry about, like title and people's background and credit and things like that. But the one thing I think is most important is basically learning how to underwrite. If you can't do that, you're in for a tough future.
Can that be outsourced?
It can.
Is that unwise to outsource underwriting?
I don't know that it's unwise. Um, I guess I'm a control freak and I want to know what's going on. But having said that, I do no underwriting anymore. I trust my wife to do it. But I think that's a special relationship because, we're a husband and wife. I think you can absolutely hire someone to do anything you don't want to do. The question is, are you sure they really know what they're doing and do you trust them? But yeah, you can absolutely hire someone to underwrite.
Okay. So, and I was starting to move towards capital expenditure for a business like this. Like, is your overhead relatively low outside of lending the actual cash?
Yeah, that's one of the things that I like most about this business is that the overhead is really low. I mean, as you can probably tell, I work from home. So does my wife. We have VAs, but it's basically the two of us. I answer the phones and she analyzes the deals. So it's possible to operate very inexpensively and be able to keep reinvesting.
Okay. So, walk us through a typical day for you and your wife. Is it it sounds like you're either answering calls, or are you dealing with clients, or is it mostly like it's all biz dev, once the loan is written, you're pretty much good to go? What does it all look like?
It's pretty mixed. I would say that for me personally, a typical day is number one, I spend my time reading. Number two, I spend my time trying to kind of think of new ideas that might help us or find problems that we're dealing with. You got to just keep learning and keep improving. And that's kind of cliche, but it's true. And then beyond that, it's following up with active clients, whether they've emailed us or making sure that they're happy and everything is going well. And then new business finally. And then typically in the evenings, if there's some kind of real estate investor meetup, I'll usually go and, just try to meet more people, expand the network.
Hmm. Is there anything in a loan, you mentioned contacting or chatting with clients. Is there anything in a loan that requires consistent check-in from you or where clients need to check in with you? Or is it as simple as kind of like, in my mind, a home loan where it's you got your loan, it's all set, here's your monthly, just pay us each month?
It's a little bit more intense than that. Obviously, yes, we expect the payments, but we do have sort of markers on our loans that where we're reaching out just to make sure that, like, this flip is doing well or that flip, whatever. On the 30-year stuff, there's no real monthly or regular follow up, other than just to check in with clients and make sure they don't need anything or we can't help in any way right now. But for the short term loans like the fix and flips or construction, we do actively reach out every so often just to say how are things going. We
Yeah.
find that it's a lot better to know as early as possible when there's a problem than to just hope everything's going well.
And on these fix and flips, like, are these on average, like, how many months are these outstanding loans?
So our average borrower takes about 5 months from the day they close to the day they sell.
Okay, and then they just pay off the loan right there within 5 months, right? Just off
Yep.
their proceeds.
Yeah.
Is that a preferable deal to a 30-year deal?
Yes. For us, yes, it is. It is preferable.
Okay, I mean, that probably explains why you're in the niche.
Exactly.
Yeah. Okay. So, and I'm starting to realize that, from the lending perspective, they're kind of the quick wins when it comes to lending, right? Where versus if you're doing the longer 15, 20, 30-year loans, now you're making your money on the
Right.
interest, but now there's a lot longer till you have the payoff.
Right. Not only that, but we charge what's called points up front. That's origination points. Most lenders charge them regardless of the length of the loan, the term. But we've learned, and you learn very quickly, that the more you can turn the money, the more points you earn. So if you could turn the money, twice a year, awesome. But if you could turn it like 10 times a year, even more awesome. So yeah, it's better to write short term loans because you're turning the money more quickly.
Okay. So you're gonna be hanging out in those rental real estate investor, or not the rental, the flip ones
There you
more
go.
often. Yeah.
Yeah,
Okay.
yeah.
And then for the rental ones, are they typically like looking at the 30 year? Or are there ones where because in my mind, you have a rental 10 units, you're making more, you're making a profit. Do they tend to take a shorter loan or they just pay them off quicker?
With rental loans?
Yeah, with rental
No.
loans.
So I mean, they basically are typical rental property owner investor, uh, buys buys the property, uses the 30-year mortgage to hold it and cash flow, usually not a ton. But the way things have been going, well, the way things were before rates started going way up, is that people would wait, for like 5 years, maybe less, and refinance to pull more money out because the market was appreciating. Since rates have basically uncapped, we're seeing that a lot less. There have been fewer refinances. They're starting to kind of creep up a little bit again because rates have come down just barely. But you're seeing less refinancing because it's not a favorable time, and the appreciation is not quite as significant as it was, say, between like 2019 and 2022.
Right, right. Okay. Just how the market is right now.
Yeah.
Yeah. Okay. Awesome. Well, Yoav, I think we're getting up against time here. This has been fantastic having you on. I want to make sure that any of our listeners out there, if they want to learn more from you, get in contact with you, that they know how to do so. What's the best way to do that?
You can find our website. It's green like the color, block like a block of wood, inc.com. You can also just find me, Yoav Gilad, on Facebook. And actually, we are having a webinar on April 9th at 8 p.m. Eastern. And if you find me on Facebook, you can register for that as well. But yeah, it'll basically be about the value of fix and flip loans to investors who are doing it.
Awesome. Okay, I love it. All right. Well, you heard it here first, folks. Check out Yoav on Facebook. Get in touch with him and get on his webinar. I hope you all learned a ton here. I know I did. This I knew nothing about real estate and real estate investing and lending. So here we are, learning something new every day. So Yoav, thank you so much for joining us today. It's been a pleasure.
Thank you, Brian.
All right.